Let's take a look at 4 ways of how to get started in real estate. 1. Fix and flip. How it works. You invest in an underpriced home in need of a bit of repair, renovate it as inexpensively as possible, and then resell it for a higher value. This strategy, also known as house flipping, can allow you to make a profit if you sell the renovated property for more than what you paid for it. Income generated, profit from selling the home. In this case, that means subtracting any costs associated with buying, renovating, and selling the home from what you make in the sale. What to consider: it can be a bit harder than it looks on TV. It's also more expensive than it used to be, given the higher cost of building materials and mortgage interest rates. Many house flippers aim to pay for the homes in cash. The other risk of flipping is that the longer you hold the property, the less money you make. During the rehab stage, you may be paying a mortgage without bringing in any income. You can lower that risk by living in the house as you fix it up if the updates are cosmetic and you don't mind a little dust. How to get started. Do market research to decide what constitutes a good deal within your budget and how to eventually price the property. Ensure you have the necessary funds, either in cash or through financing, to secure the deal. Consider working with a partner or contractor to assess the potential cost of repairs and to gain a projected timeline. 2. Rental properties. How it works. If you have some capital to spare and don't mind property management, you can consider buying physical property and renting it out. This could be a house, apartment building, or another type of residential or commercial property. Income generated, regular rental income. Keep in mind that tax rules can become complicated when you start collecting rent as income. Make sure you talk with an advisor to understand all your obligations, as well as any tax breaks which may be available for rentals. What to consider. If you want to buy and rent out an entire investment property, look for one with lower expenses than the amount you can charge in rent. And if you don't want to be the person who shows up with a tool belt to fix a leak, or even the person who calls that person, you'll also need to pay a property manager. How to get started. Work with a real estate agent and financial advisor to find a property that fits your budget and long-term investment goals. Consider location and crunch your potential return on investment. You'll also need to understand your legal responsibilities as a landlord. Also, make sure you have a clear understanding of your upfront and ongoing expenses. 3. REITs. How it works. Real estate investment trusts are companies that own commercial real estate. This includes office buildings, retail spaces, apartments, and hotels. REITs generate their income from rent collection. Investing in a REIT is similar to investing in a stock or fund. Buying a share allows you to dip your toes into real estate without owning the physical property. Income generated. REITs pay dividends, which are steady and routine payments made by the company to the investor on a regular schedule. This consistency makes them a common retirement investment. Investors who don't need or want a regular income can automatically reinvest those dividends. Also, dividends are taxable in the year they're received. The exception is if they're held in a tax-advantaged account, such as an individual retirement account. What to consider. Are REITs a good investment? They can be, but they can also be varied and complex. Some trade on an exchange like a stock, while others don't. The type of REIT you purchase can be a big factor in the amount of risk you're taking on, as non-traded REITs aren't easily sold and might be hard to value. New investors should generally stick to publicly traded REITs that can be purchased via an investment account. How to get started. If you're interested in REITs, you can purchase them through a brokerage account. Opening an account takes less than 15 minutes. You can gain exposure to a diversified selection of real estate investments by buying into a fund with interests in many REITs. You could do this through a real estate ETF or by investing in a mutual fund with multiple REIT shares. 4. Real estate investing platforms. How it works. Real estate crowdfunding investment platforms connect developers with investors. These investors are looking to finance projects in the private market, usually through private REITs. The benefit of a platform like this is the potential to generate higher returns than those investors might receive through a public REIT. However, this comes with greater risk. Many crowdfunding platforms also offer access to alternative investments like art and collectibles. Income generated, investors hope to receive monthly or quarterly distributions. This is in exchange for taking on significant risks and paying a fee to the platform. What to consider? Like many real estate investments, these are speculative and illiquid. You can't easily unload them the way you can trade a stock. This means they may not be a good fit for investors who may need to sell or convert funds quickly. How to get started? Many of these platforms are open only to accredited investors. The Securities and Exchange Commission defines these investors as people who have either A. Earned income of more than $200,000, $300,000 with a spouse in each of the last 2 years. B. Have a net worth of $1 million or more, not including a primary residence. Alternatives for those who can't meet that requirement include Fundrise and Realty Mogul. Be sure to like and subscribe to catch the next video from New Day Property Redevelopers.